And if you're in charge of your money, you can do the same thing with your money, whatever they are doing. Instead of getting small crumbs, you can have the whole enchilada there. So I wanted to ask you this question here. Many people are not aware that they can invest or leverage their 401k or their retirement accounts to invest in real estate syndications, like we were talking earlier before we started recording this podcast. So what approach they should be using, or, what do's or don'ts they have to do in order to get started?
So first off, if you want to invest in any type of syndicated deal, like a multifamily project, you need to understand that your payout is not upfront, right? I'm not going to make money today. An average multifamily deal is going to probably last about 5 years.
Mm-hmm.
Well, this means I'm going to get a big payoff in the end. Now, if you do the same investment personally, what happens is you end up draining your own personal bank account, money that you use to pay your bills, go on vacation, buy groceries.
This is the Real Estate Wife Show, and I'm your host, Vinki Loomba, a commercial real estate investor. And today I have a very good friend of mine with me. His name is Derreck Long. Welcome, Derreck. I'm super excited to have you on the Real Estate Wife Show.
Absolutely. Thank you so much for having me. I've been excited. This has been one of the fastest growing podcasts out there, so I'm excited to be on it.
Thank you so much. A little bit about Derreck. He's a Senior IRA Specialist with Quest Trust Company that works on government relations team reviewing court cases, tax code, and law changes. And today our topic of discussion is very interesting. It's about unlocking your financial freedom, self-directed IRAs, and art of tax-free investing. So let's start with this question, Derreck. Can you explain the concept of leveraging your 401k for the real estate syndications? And what does this strategy entail? Just a basic question that everybody asks me. Let's start with that.
Yeah. So one of the biggest things is people are always taught in America to be saving up money, and you save it up by putting it in a 401k, putting it in an IRA, putting it in any type of retirement account. The problem with this is if I ask those same people what it is that their 401k is invested in, most of the time they don't know. I'll get the answer of some large caps or mutual funds. Whereas if you can actually find a custodian that will allow you to invest in things like a syndicated investment, a limited partnership, a multifamily deal, maybe something you're more familiar with, that's all we're trying to do. All right. You need to find someone that lets you invest in what you know best, what you want to do. And I think that's the real goal there. And that's where you actually build real wealth. That's where you make real capital. And it's a great way, not only that, but to see what your money's doing. You see it build up something in the community. And there's nothing like that feeling. There really isn't.
You use the word custodian. So what is an individual retirement custodian account, and how that is different than your regular 401k?
Sure. So an individual retirement account, right, or we always shorten it up as an IRA, is something that the individual has full control over, no matter which custodian you go with. And custodians could be a Fidelity, a Charles Schwab, Quest Trust Company, which is where I work, Merrill Lynch. It doesn't matter. Insert one of them, right? So an IRA is one that you have full control over. A 401k, your employer has full control over because it's tied to a company. So there's not one that's really better than the other. There's times that it makes sense to have one over the other, especially if you are the employer. However, the IRA is more common because it's definitely designed for the individual.
So you name a couple custodians like Merrill Lynch, Charles Schwab, but they won't let you place your money in the private placement like the syndications or real estate syndications. So what is the difference between the companies like Quest, Advent IRA, or Merrill Lynch, or Charles Schwab? Like you said, at some point, one might be better than the other. So if you can, shed some light on that. Sure. And help my viewers and myself understand the difference so we can make better decisions for ourselves.
Well, it's funny. There's technically no legal difference, right? There's no legal difference, especially at the IRS level or the Congress level. They don't look at Fidelity and Quest as two different types of companies, right? We're actually the exact same type. The difference is what the company allows you to invest in. As an example, if I have an IRA at Fidelity, Fidelity will only let me invest in stocks, bonds, CDs, mutual funds. If you have an IRA with something like Quest, we will only let you invest into things like real estate style assets or oil and gas. So which one's better or worse? Neither. If I want to buy Apple stock, I have to go to Fidelity, use my IRA there to buy Apple stock. But if I want to invest into a multifamily project, I have to come to Quest. So a lot of times people think there's a big difference between us, and it's not that there's a legal distinction. It's just different in what the company lets you invest in. So find a company that works well with you, that can let you invest into what you're the most knowledgeable. I see sometimes people want to invest in gold and silver. There's people that have IRAs that is just designed for that, or cryptocurrency or small business. There's not one that's better than the other. It's just different. Does that help?
Yeah, it does. But why that differentiation? Why some have restrictions on certain things? Because when you talk to the investors, sometimes they say, oh, I have an account with Merrill Lynch. Why do I need to move my account to some other custodian in order to put my money in a private placement like a real estate syndication? So there's a hesitation right there, because it's very hard concept for them to understand that I'm already with a custodian. Why should I move my account in order to leverage for the real estate investing? So why, these companies, they have certain restrictions, or how do they pick that I wanted to keep this portfolio only versus including the private placements too? It's like the size of the company matters, or the portfolio of the
that's
company
actually
matters?
it. So if I go to Merrill Lynch, right, and I have my IRA there, the reason they only offer you a mutual fund or annuity or a stock or whatever it is they actually receive a commission off those investments. So when you talk to someone on the phone, you're usually actually talking to a broker, someone that's there designed to sell you an investment. Now, this is both good and bad. This is good because that means the more money they make you, the bigger their commission is. This is also bad, though, because it doesn't mean they'll always have your best interest aligned. A lot of times they'll have their own personal interest aligned. So you have to be really careful in these situations. So it's not that a company like Charles Schwab or Merrill Lynch or anything can't allow you to do real estate stuff. It's they don't want you to. So at a higher level, they train their employees, oh, well, that's not allowed or that's not possible. And believe it or not, unfortunately, the broker that you're talking to on the phone, they don't even realize it's an option. Now, when you come over to someone like Quest, we don't make any money off any of your investments. But so how do we make our money? We have to charge you fees. So we charge you fees up front before you even do the deal. So notice one of us is going to charge you fees. The other one's going to charge you off your profit. So once again, it's just different. If you want to hold a mutual fund or an annuity, yeah, stick with Merrill Lynch. That's what they're good at. Stick with Fidelity or Charles Schwab. But if you're looking to do limited partnerships, you have to go to one of those private style custodians that allow for that. So try not to think that one's better than the other. It really is. We're all just different.
The strategy. Thanks for sharing the secret. Actually, this is actually a big secret of the stock market. That's the reason they don't encourage people to invest in real estate or put their money in the private placements, because they're not making any commission. That's the big secret. People need to know that, because you want it to be in charge of your own money versus having somebody else in charge of your money. It's not like that you're paying them a point or two as a commission, but on top of that, they are making money off of your money. And if you're in charge of your money, you can do the same thing with your money, whatever they are doing. Instead of getting small crumbs, you can have the whole enchilada there. So I wanted to ask you this question here. Many people are not aware that they can invest or leverage their 401k or their retirement accounts to invest in real estate syndications, like we were talking earlier before we started recording this podcast. So what approach they should be using, or, what do's or don'ts they have to do in order to get started?
So first off, if you want to invest in any type of syndicated deal, like a multifamily project, you need to understand that your payout is not upfront, right? I'm not going to make money today. An average multifamily deal is going to probably last about 5 years. Well, this means I'm going to get a big payoff in the end. Now, if you do the same investment personally, what happens is you end up draining your own personal bank account, money that you use to pay your bills, go on vacation, buy groceries, right? You're going to drain that personal bank account to do this investment, and you're not going to see a return for a long period of time. But if we can use your retirement account instead, this is money that you've already been saving up out of sight, out of mind. You're not thinking about it on a consistent basis. This is probably one of the best vehicles to utilize in any one of these aspects only because of that reason. Notice I'm not trying to live off that retirement account today. So it makes sense to use these in these longer term investments. So the next step then is just how do we actually use it? It's simple. You just find a custodian you like to work with and start off by setting up a self-directed IRA. And there's a lot of them out there. I do work with Quest, so I firmly believe Quest is the best, but I mean, there is several custodians out there that can fit your needs in those situations. So just know, where's your money sitting, right? Do you have more money in the retirement account or more money in the checking account? Where do you want to do the investment from? Do you want to do it from here or here? There's not a one that's better than the other. It's, once again, it's always different. So does that help?
Yeah, it does. I like that analogy. But at the same time, I need to mention over here, it's not just that you get the big check at the end, but there is a cash flow too, that you're getting some money on the quarterly basis too. So you can strategize it whatever way you want to do it. And if you're using any money to set up your account, creating a new account with a custodian, all the upfront fee that you're paying, you should be able to take that off your retirement account. Is the correct statement that you can use some cash flow there?
Absolutely, you can. So any fees you're paying to a custodian, first off, doesn't matter which custodian you go with, should never be making or breaking an investment decision. As an example, Quest were to charge you $350 a year. Like that's, if you're investing $100,000 in a multifamily deal like that, $350 a year is not going to break your deal. That being said, a lot of people would rather have that $350 a year deducted from the IRA. Why? I think it's one of those out of sight, out of mind type things. It's easier for bookkeeping. And if there is any taxes owed, you can use that as a write-off. Some people, though, we see them actually put a credit card on file. They'd rather pay any of the custodian fees via a credit card to keep their retirement account balance as large as possible. That is something that's designed for their retirement, so they can justify that. Once again, there's not a right or wrong way to do it. I do see more people have it deducted from the IRA, though.
So are there any potential risks associated with leveraging your 401k to put it to real estate?
Absolutely. There is a lot of risk involved, but the risks are not the same as the risk investing in the stock market. When I invest my funds in the stock market, I have no control if it goes up. I have no control if it goes down, right? So if the market crashes tomorrow, there's something to be said. It's not my fault, even though you lost a lot of your money, but that still stinks. So you have zero control over it. The problem when we invest in real estate is you have full control over it. I chose which multifamily project I wanted to invest in. I chose the limited partner, or the general partners I wanted to work with. I chose how much money to invest. I chose the location, that I want to invest in, because you're making all of these choices. And there is not someone behind the scenes making the choices for you. Could you make a bad decision? Absolutely. So the best thing you can do is actually do a lot of due diligence on the front end. Know who it is you're investing in. Look for people that you can trust, that you can reach out to. Make sure you do the research to, minimize those risks of your investments. And that holds true for anything. It really should be. Whether you're buying a single family home, investing in multifamily, investing in oil and gas, it doesn't matter. You have to do your own due diligence. So that's the real risk, because there's someone that they just jump into it because they didn't want to do any research.
That's true. I mean, you mentioned research and due diligence. Those are the key things, in any kind of investment, even the stock market too. You pick and choose which stock you wanted to invest in, right? You research, you figure out what others are doing. You're not jumping in a similar way you wanted to do in the real estate with syndicator you wanted to work with, what their track record is. So do you advise anything like that to any of your clients who are switching their accounts to your company?
So we never advise on any investments, all right? And no one ever gets real investment advice. That never happens, all right? Unless you want to pay an attorney, right? No one's giving you investment advice. Even the broker that you think you're talking to that's selling you investment, and they go, well, and you listen to their language, they'll say something like, I think it's a good investment. I'm not going to tell you what to do. They'll say something along those lines. However, we do teach classes on how to do due diligence. How can you read the contracts? How can you vet the deal? How can you run your comps? What are things you should look for in a construction loan? Or what should you look for if someone is building up a multifamily project? And we actually teach these classes on a very consistent basis so people can do the right due diligence. And all the classes are free. You don't need to be a client of Quest or anything along those lines. So I think that's the best thing, is just understanding where to get the education from and knowing that it's good education. It is impressive and almost crazy to think about how many people, when they jump into real estate, they've never actually read a real contract, so they don't really understand how to read it. What's an operating agreement? What's a subscription agreement? Someone asked me if I'm an accredited investor. I don't know what that means. Well, that's okay. We can teach you all of that at no cost.
Mm-hmm. So thanks for sharing that, that you have a lot of educational resources. So when you're teaching those classes, can you share with us a couple pointers here? It's just like on top of your mind, what should investors look for when they're doing
so the first thing, if I'm a brand new investor, right? Someone who's never done a deal, this will change if I'm a more experienced investor.
Mm-hmm.
First off, I typically, if I'm looking at the multifamily sector, I probably want to invest in someone that's a little bit more experienced, right? Someone that's been around the block, someone that this is not their first multifamily project. The problem right now in multifamily is everybody's raising capital for it because it's a hot commodity. So the problem is if you're dealing with a newer person and you're new yourself, you're going to run into a lot of risk and pitfalls. So step one, I'd always say if you're a brand new investor, look for someone that's been around the block. What's the downside of this? You're probably not going to get the same slice of pie. They're going to probably give you a smaller share, but it's because of their experience. They know what they're doing. They have all that, and that's what they're bringing to the table. So it's okay for you. This will give you that experience, that education. Next, it sounds silly, but social media. Man, people love to complain on social media platforms, Facebook, Instagram, LinkedIn, it doesn't matter. So before you make an investment with someone, look up their company, look up the individuals that run it, look at their social medias. You'd be surprised how often someone's sitting there and saying, hey, I invested in you. You're not returning my calls and you took my money. Like, if I see that, it's going to probably raise a red flag for me, And these are just some of the tips. I mean, I can keep going. I can go all day long if you want me to.
This is really good. I like that. So like we were talking earlier, if you can share some success story, if you have any case study in your mind that something happened, how somebody leveraged their 401k. And I think you can leverage your 401k in a way that when you're working too, let's say if you're an active employee, some of the companies, they let you do call in-service rollover as well, some percentage of your 401k into your self-directed IRA account. So if you can share any story regarding that or any small thing that was funny or insightful for my audience.
So one of the, I love to tell this story. I have a client by the name of Ann Minks, and she loves it that I tell the story, but I don't agree with her investment, but she knocked it out of the park. Her and her husband worked in the oil field for quite some time, and they had what I'd consider to be sizable 401ks. It was a little over $1 million, about 1.1, 1.2 million, just sitting in a 401k. They chose to take that entire $1 million. They put it into a self-directed IRA, and they did one multifamily investment. Now you have to understand, this is money they were saving up for about 25 to 30 years, and they've been shoveling this money away. At the end of 4 years, that $1.2 million more than doubled. It ended up becoming about 2.7 million.
Interesting.
And it was insane. And they were so excited. And they wrote us this big, long letter. And what ended up happening is, as they wrote this letter, they said, we want to take a moment. We want to say thank you, because understanding how to use a self-directed IRA and understanding how to do the due diligence, we were able to double our entire retirement savings with one proper real estate deal, and it's so unique that once you really understand this, it can change your life.
That's true.
I don't agree with how they did it, because what they did is they took their entire retirement savings. They did one investment. I would argue, hey, guess what? Let's just maybe split that into 3 investments. Let's do 300,000 in 3 different ones just in case. But no, they went for it. They did all of it in one, which is good for them. And they love it that we always tell the story and things, because it's one of those topics where if you know what you're doing, you have a good mentor, you have a good person to invest with, good partners, you really can make the biggest difference in just the money that you can make. And you'll hear that story all the time. I'm sure you have yourself, right? Multifamily investments right now have blown up, where people are doubling their money after that 3, 4, 5 year time frame.
That's true. I mean, that's what we target for too all the time. But this is a good story. But look at that, in 4 years, they made $1.2 million more, right? On top of 1.2 million that took them 20 years to accumulate. So look
Exactly.
at the time frame, that's the power of real estate investing or investing in the real estate syndications, because you don't have to worry about the tenant, toilet, termites, you're not doing anything. You're just saying you're staying 10 feet away and still getting all the nitty gritty of the deal.
Absolutely.
So, that's what I would say. That's the power of real estate investing. So let's talk about now, shift gears here a little bit about the taxes. They made $1.2 million, like double up their money. So how did the tax situation was for them? How did that work?
So for the client, they actually, prior to doing this, most of those funds were in a Roth IRA. So believe it or not, that over that $1 million was 100% tax free. So for them, they owed zero taxes on this income. And I think that's one of those advantages that people miss in the retirement account. That when you do an investment personally, you are a taxable entity. You make profit, you have to pay your taxes. But the IRS says that your IRA is a tax exempt entity. So what ended up happening is they did the investment, the IRA made the profit, the IRA did not owe taxes. Now, this didn't mean they didn't have to file a tax return. And they had to file a tax return based off something called unrelated business taxable income. A lot of people call it UBIT for short, but the section they brought in something called UDFI, and we can talk about that as well. But they did have to file something, but they ultimately didn't owe any form of taxes, which was very unique.
Interesting. So I really wanted to talk about the UBIT and UDFI, but before that, let's talk about the Roth IRA.
Yeah.
So this is another class of the IRA account, right? There's a self-directed IRA, which you have the complete checkbook control, if I'm not wrong. So if you can talk about that, and also tell us about the Roth IRA, how does that work, and what is the differentiation between the two?
Sure. So most people out there, you have what I'm going to refer to as a tax deferred retirement account. You have an account you've been saving money in. As you've been saving money, it's been growing tax deferred. You're deferring any taxes until you're old, right? And that's what the IRS says. But there's a different type of account, and we're going to label it a post-tax account. This is a Roth IRA typically. There's other ones like a health savings account and an education account and stuff that can be also tax-free or post-tax. But the Roth grows the exact opposite. When you put money in it, it grows and you owe zero taxes on the earning. So this is a huge advantage. So why is it though that everyone has a tax deferred account? Well, they have these tax deferred accounts because your company paid into it. They gave you free money into your 401k. They gave you free money into that pension plan, that TSP, that 403b, whatever it is. Well, the company doesn't give you free money because they like you. They gave you that free money because it's a tax deduction to them. This is why when you pull it out, you have to pay the taxes. So don't be mad. That's why they gave you free money. If you give me free money, you have to pay taxes. I don't care, But that's why everyone has one of these tax deferred accounts. But if you do it right, we can take that tax deferred money, put it in a Roth IRA, and now the growth is really tax-free. So that's, I think, the goal that everyone wants to get to, is get that tax-free growth. And it's not just tax-free for you, it's even tax-free for your heirs.
Oh, interesting. So how about this UBIT or UDFI? How does that work? Because mostly, like you were talking about, if your 401k, your employer is contributing, because that falls under UDFI or UBIT, right? Because that's an unrelated business income, I would say, at that time. And then when you're doing the tax deferment, at some point you have to pay taxes. So you're leveraging your self-directed IRA account because you don't want it to pay taxes and you want it to grow your money. But let's say at the end, I'm 72, I'm retiring now, and I wanted to take the money out. So what are the tax implications at that point?
Yeah.
And can I leverage whatever losses I have accumulated over the years through the cost seg or the bonus depreciation?
So we're going to separate these two because it's kind of two different questions. So we'll start off that you're in your 70s and you want to pull the money out of the retirement account and spend it for personal use, not investment use. Okay, you're spending. So when I say personal use, I mean vacation, buying a car, buying groceries, whatever it is, right? Well, when you pull money out of a tax deferred account, like a traditional IRA, well, then those funds are added to your modified adjusted gross income. So whatever income bracket you're in, just add those funds to it, and that's going to be your tax bracket. People will always say 20%. That's just an estimate, right? You could be in a higher, you could be in a lower bracket. It's whatever your current tax bracket is. That's how much you owe. Now, that's on the IRA side. Now, when we do this movement, This has nothing to do with any of your investments. This has nothing to do with the real estate or the multifamily deals, nothing like that. So if you take money out for personal use, the tax deductions you claim are coming from your own personal either investments or losses or whatnot.
Mm-hmm.
Separate topic is the UBIT UDFI.
Mm-hmm.
Now, when an IRA or a 401k or anything along those lines does a real estate investment,
Mm-hmm.
if the IRA borrows money from the bank to complete the deal, indirectly or directly,
Mm-hmm.
it doesn't matter. Well, then the IRS says, hey, we're going to tax you on that profit.
Mm-hmm.
Well, I thought you said the IRA wasn't taxed, and that's what I was saying earlier, but they're not taxing you on the IRA's profit. They're taxing you on the profit that was debt leverage, because that wasn't the IRA's. That was money borrowed from the bank. Well, in these cases, the IRA then will claim the cost segregation that a multifamily deal has, any deductions, depreciation, HOA fees, insurance fees. And you can see all of this on the K1s that show that big negative balance.
Mm-hmm.
So what's nice is the IRA in these examples, it doesn't have to, it claims all those deductions, and 95% of the time, there's enough deductions the IRA doesn't owe any taxes. If it does, it's a very small amount compared to what you made. So what's nice, though, is knowing the IRA has a way to claim those deductions off any of the profit it makes. Does that help?
Yeah, it does. And then when you say, when you're taking the money out for your personal use at age 70, right? So that's considered as your ordinary income. So you go into the ordinary tax bracket. So what are some of the tax saving strategies can you recommend or can somebody use to lower your tax bracket and you're not paying that much taxes?
So option one is
Mm-hmm.
take the hit all at one time,
Mm-hmm.
right? So this will put you in the highest bracket most likely for the first year, but you'll never pay taxes again the rest of your life. So if I have $1 million, just as an example, and I say, you know what, we're going to put it, and I'm going to choose to pay all my taxes right now on this $1 million. Assume you're in the 40% bracket, that's $400,000 you owe in taxes.
Mm-hmm.
What's nice is the $600,000 you have left grows tax-free. You never owe taxes again for the rest of your life. You can live off that. You can, which is hard to live off nowadays, but just as an example, but any investments, tax-free. If you could double it, tax-free. It doesn't matter. So this is a good option, option one. Option two, believe it or not, is even though we're doing investments outside or inside our retirement account, investments outside of your retirement account can be used to offset personal taxes. I currently own 3 rental properties,
Mm-hmm.
single family homes.
Mm-hmm.
These rentals don't make me a whole lot of money. They really don't. As a matter of fact, they're a big headache. But every year, the depreciation and the expenses that go back into the property offsets, believe it or not, all of my W-2 income.
Mm-hmm.
So I can own an asset, let my tenants pay down the loans that I have on it, don't make any money today, but where I'm making the money is it offsets my taxation I currently owe from a W-2 job. Well, this is nice because I technically actually make more money. And then at some point down the road, I'll sell those properties and make a whole bunch of money on them.
Yeah, but then you are liable for
Capital
big
gains at
tax.
that
Yeah,
point.
capital gain. Yeah, there's going to be huge tax on that too.
Hmm.
So you have to figure out a way somehow to go into the debt situation again because there's no taxes in debt, right?
Yep. And
That's
at
the
that
best
point
way
in
to do it.
time, you have a couple of options.
Mhm.
Let's say you just sold a single family home. You just got a big payoff. And you're like, oh man, what do? I don't want to pay all the taxes on this income. A great solution is something called a 1031 exchange.
Mhm.
And this is where that cash, instead of going into your checking account, will actually stay at the title company
Mhm.
and you roll it into your next investment. Now, this sometimes, depending on who it is that's doing the syndication, sometimes it can roll into a syndicated investment like multifamily. Sometimes it rolls into a single family home that you're looking to purchase for Airbnb purposes, maybe, or sometimes it rolls into an oil and gas investment. That's a great option. But I always tell people, all you're doing is really delaying the problem,
Yeah, basically it's a tax deferment anyways, you can keep on doing all your life. Just pick out the buckets, different buckets, where you can put your money and save, do the tax savings. And your heirs can do the same thing too. It's
Absolutely.
basically, it's kind of tax planning or just creating the tax strategies that fits your criteria. So for those who may be new to this concept of tax-free investing, what resources that you can share or any kind of guidance that you recommend to my viewers or audience?
Sure. So step one, find a good IRA Specialist. Now, Quest, we have 30 of them on staff. So find one that you have a good connection with. It could be myself or it could be anyone else. We don't get commissions. We don't have any investments to sell you. So the best thing is get real education on your retirement account without being pressured to or be sold something. And I think this is the key right here. And that's what helps people understand. Because once you understand how to use a retirement account properly, how to avoid the taxes on investments, now you can go find a proper investment that you're familiar with. And so I'd say that's the step one, is find a good IRA specialist that you can connect with, that understands what your needs are and is not charging you fees when you need to talk to them on a consistent basis.
I like that because it's very important, because you can only work with the people who you resonate with, who you understand, who understand your story actually. And they can help you see all the loopholes, or they can help you see any issues or pain points and help you mitigate all those issues. Not just because everybody else is doing that, let me do that. So I like that advice. So I'm going to ask you here one more golden nugget. It's not like that you didn't share enough, but one more golden nugget, a good takeaway for my audience.
The biggest takeaway I think I could give anyone has nothing to do with IRAs or tax-free investing or anything like that, but it's always get started. Too many times I see people miss out on investments by and I call it the analysis paralysis. You know, you need to know every single detail. You want to look at all up, down, left, right, and you end up missing out on your investment only because you were so consumed by the numbers. Don't be that guy. Get started. Find something that you're passionate in and invest in that. It doesn't matter what it is. If you're passionate in it, you'll make money. So my biggest gold nugget I can give anybody is always just get started. Because it's crazy. People just, they get scared.
That's true. I see that. A lot of hesitation, a lot of fear. And you have to understand where the fear is coming from. The fear is because you do not have enough knowledge. If something is not in your experience, you're hesitant to try that. And then you have to understand that if you're keeping your money in the bank or in your retirement account, your money is losing its value. Every day you have less and less money. So better act now. So this brings us to our rapid fire round. I'm sorry, the conversation was so well, and I can keep on going, but the thing is I'm out of time. So let's move on to a rapid fire round. I'm going to ask you 5 questions and spontaneous answers. 1 word or 1 sentence only. Are you ready?
I'm ready.
All right. So the first question is, if you could invest in 1 asset class for the next 10 years, only 1 asset class, what would that be and why?
Storage units. And the reason why is Americans like their junk.
I know. I love that. See people's homes, they have huge garages and they're filled with all the garbage and the, like thousands of dollars worth of cars standing outside on the driveways or on the street. That's sad. So share with me 1 good book that you like and recommend to my audience.
It's called The Apprentice Model, and it's written by Dr. David Phelps. Very few people have heard of it. I love this book because it talks all about the golden handcuffs. The people that have made millions of dollars working being a doctor, attorney, a senator, something like that, but they're chained to their desk, and they could be a millionaire, but it's equivalent to you working 100 hours a week at a restaurant, and they don't know how to get out of that race. So I love it. It's called The Apprentice Model by Dr. David Phelps.
I like that. Yeah, I will put that in the show notes, that book, and I will check it out as well. So next question I want to ask you, if I give you $1 million right now, what would be the first thing that you invest in other than storage? Or maybe let's make this question even better. Let's say if you have $1 million sitting in your 401k and you are a current employee, how would you leverage that?
I'd put it in 2 different investments, maybe 3, and it'd be very, very quickly. The first one would be a multifamily syndication. This is because these have been blowing up, and I know that I have enough resources and due diligence to find the right multifamily syndicator. The second one would probably also be storage units. This is because it's structured very much the same way. It is still a syndication. It's still somewhere, and it's along the same platform. And the last one would actually be into something in the energy market, but not oil and gas directly from a drilling aspect or something, but maybe more like either mineral rights or clean energy like solar. That would be the most risky one, but that's why I'd split it up into 3 categories. I think that could be the most profitable, but also the most risky. So I want to take less risk with the other 2 categories where I know I can make a good profit. And I'll take a little bit of risk over here too.
That's really good. So let me ask you a question about life. What does life mean to you in one word?
Time. That's it. Just time. And the reason why is prior to doing any of this stuff, I was in the military. Right. I spent 6 years in the Army. After that, I worked at the FBI and I learned a lot, but I saw so many people waste their smarts and their time, and they spent time away from their family and they didn't know how to get out of that. If you see the people that are really happy, it's the people that they're not showing off their cool cars or their yachts. You see them, they're on vacation with their kids, with their wife, with their son, with their daughter, with their, their husband. They're out there and that's what it is. They found a way to have their time back. So that's what life is. It's just having time.
That's true, because they value time, and everybody knows it's not infinite. It's finite amount of time that you have. But people forget that, they get into this entanglement and all this. They create their whole universe like, okay, I'm here forever. So that's when you forget to live. And you said, you put it very well in a way saying that live your life. It's not the material that count, material things that count. It's the moments that count. So let me ask you that. If you could turn back in time and talk to your younger self, what would that be and why?
That's so funny. First off, I probably want to join the military. I probably would have actually listened to my dad. That old man actually was kind of smart. Who knew?
I know.
But the reason why is my dad wanted me to be a real estate investor originally. My dad has been a real estate investor for the last 20 plus years and built a large company that he has full control over. And it's funny, I said, no, that real estate thing's not going to do anything. I'm going to go start a restaurant. That failed miserably. And so what was funny is about 15 years went by and I started looking at this real estate thing, and my dad would always have me partner on certain investments, very small. And I realized I was doing very little work for a very small rate of return, but it was nice because it was consistent, seeing a note come in, and it all started off with notes. And that's what I did. I'd be like, look at the real estate thing sooner. Get started in that. Listen to your dad.
That's true. I agree on that, right? But, you only get wiser as you get older.
Who knew,
when
right?
Younger,
that old man was smart.
You're super smart when you're younger, right? That's why you don't care what the older people say. But
exactly.
Anyways, it was a good conversation. How can people reach out to you, Derreck?
The best way I always tell people is you can either email me, you can call me. It's a non-automated line. Phone number is 281-492-3434. The website's Quest Trust Company. If you want to email me, it's my email's weird, so I'm going to give you my I have 2 of them, but I do info@questtrust.com. And so just let me know how I can help out. Remember, we have 30 IRA specialists on staff that can work with you at any point in time and answer any questions, and just let us help you out.
Thank you, Derreck. I really enjoyed our conversation. I will add all your contact information in the show notes.
Thank you so much for having me. And guys, make sure you listen up to more of these podcasts. That's why they always get hosted. So thank you so much.
Thanks.